Company. I'm David Blain, and we're talking about some issues that are going on in the bond market, and we're going to get to your mail in just a minute. But let me finish up. We were talking about the fact that the bond market has been in a secular decline, meaning the yield has been in a secular decline from a peak in the 80s of around 15% on the 10-year Treasury to a bottom of around 2% in 2008. And so for prices, this has been great. It's been a huge boom in prices for bonds because as the yields have come down, the prices have gone up. And so it's been a great time to be a bond investor. And as we get to our viewers' email here in just a minute where they ask about financial bubbles, it's my belief that the bond market is probably one of the next bubbles, that we've had this huge, tremendous, multi-decade decline in yields, which has provided a tailwind for bond returns, and that's just not going to be there in the future. That as rates start to creep up, the bond investor is going to be facing headwinds. Sure, you're going to be able to be paid more interest. If rates go up, from 4 to 5, you're going to be earning 5%. But if you already own a bond, it's going to go down in value. And if you need the money and you have to sell it, it's going to be down in value. So it's my contention that today the bond market, especially the Treasury market, is probably on a secular or long-term basis a little bit overvalued. And there's a lot of caution to be warranted for bond investors. Fair value on the 10-year Treasury remains, I think, about 4% on a short-term basis. But long-term, we're probably going to see those yields creep up. As the Treasury needs to continue issuing bonds in the future, they're going to have to pay a higher interest rate. And as inflation heats up, we're probably going to see bond yields rising, which is bad for bond prices. So it's just something to keep in mind. Well, let's look at some of our issues that have come up from several sources. A couple people ask about this. The question is, with financial bubbles seeming to be a regular occurrence, what can individuals do to prepare and protect themselves from the next one? Well, that's a great point. We've seen the bubble and bust cycle in financials between 2008, 2009. Of course, we're still in a residential housing bubble. I'm not sure we've seen the bottom of that. The commercial real estate bubble is starting to burst. And of course, if we go back to the year, the late 90s with the technology bubble bursting in 2000, and people are bubbled out and they don't know what to do. Well, the first thing I want to say, as I've mentioned many times before on the show, is that bubbles are not something new, and you are not the first person to go through them or experience them. We've had several compressed in a short time period, but there's the famous tulip bulb bubble, I think, is the first ever recorded bubble in history. Way back in the Middle Ages, that tulip bulbs from Holland were very popular around the world, the different colors and different varieties. And believe it or not, people used to trade in tulip bulbs, and they would use them as essentially currency, and they would purchase them and collect them and resell them for a profit. And there became tremendous bubble in tulip bulbs. There's several fascinating books out there about the tulip bulb mania that occurred. I think it was back in the 15 or 1600s. But it's a fascinating story when you look back in history. And as you all know, I'm a big fan of studying history to learn about what's going on today. And we see that there have been bubbles throughout time, and so this is nothing new. So what can you do to prepare? Well, the first thing is look at what you're trying to accomplish. Are you trying to save for, retirement, old age, something like that? Are you trying to make a quick dollar, in the markets? Is this your business? Some people took, investing in, say, real estate, and it really became a business more than investing. And so you have to look at your long-term goals, and we're just going to assume here that you're, like most people, and you're investing to compound your savings, that you have a business or a job, and you're saving funds from that and you're trying to multiply your savings. Well, if that's the case, the important thing is that you don't become over infatuated with any one particular type of investment. You don't put all your money in technology. You don't put all your money into the real estate market, that you remain fairly diversified across different sectors. The other thing, and this is just good common sense, but it also helps protect you from these bubbles, is you have got to rein in your spending and keep your debt at a manageable level. And then what happens is when the financial crisis of 2008 strikes and you have a very low living expenses, you have very low debt, is you look at that as an opportunity. And you don't look at your 401k or something like that as going down and panicking. You look at it like, well, I don't have much debt. I don't have very many expenses. This is a great time to buy things. And so that's the main points I want to get across, is just maintain your diversification and keep your living expenses and debt low, and you will be very prepared for the next financial bubble that comes along. In our last 2 minutes here, I want to address something that, I was interviewed for an article in the New Bern Sun Journal last week. It appeared on the front page of the paper. I believe it was Tuesday, if you haven't had a chance to read it. But it was about regulation of the financial industry. And as we had the meltdown in the banks and things like that, there was tremendous outcry for new regulations and more regulations for the financial marketplace. And as part of my involvement with some financial organizations, I've provided some valuable input to our political leaders as far as how to reshape this legislation. Well, one thing that did not necessarily come across in the article that I wanted to make sure that we emphasize is that I am not for more regulation. We don't need more regulation of the financial industry. What we need is enforcement of the regulations that are currently out there, as well as holding all people claiming to give financial advice to the same standard. We've talked about this a little bit before, but you have people that are fiduciaries, meaning that they are required by law to put their clients' interest above their own, such as my firm, D.L. Blain Company, a registered investment advisor. And then you have a whole other group of people that call themselves financial advisors that are not required to put their clients' interest above their own. They're only required to make sure that that investment at the time was suitable. And so I just wanted to make that clear, that we're not advocating more regulation. We just want everyone regulated under the same standard, and the rules that are currently out there, we want them to be enforced. Well, that's all the time we have for today. For All Things Money, I'm David Blain. Thanks for joining us, and hope to see you next week. Thank you.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media. The following is a paid program. The